Hello, a very good morning to everyone who's tuning in to today's webinar. Benjamin here, speaking on the line. Right, for this week and the next 2 weeks, we'll be focusing on the earnings results of the various companies they're under our coverage, right, instead of specific companies, right, as we think that it's a good time to get in touch with our coverage list as well as find out what's going on for the third quarter of this year. So first up, I myself will start off with the banking sector first, right? There's 3 banks reported last week over Thursday and Friday, right? So for the 3Q results, it was a very good set of results that they produced. So hence, therefore, you can see that their share price has been rising over the last couple of days, right? And also propping up the STI as well. So for OCBC, it was released on Thursday morning. Their 3Q results, right? On surface itself, it seems really positive, 62% up year on year, right? But in fact, it's only largely in line with our expectations once we strip out all the OCBC Wing Hang's contribution, right, which they have consolidated 2 months of results, right, into their P&L sales balance sheet. Right, so for the loans growth momentum, right, for OCBC itself, it's only up 1% Q on Q. I mean, stable, but pretty slow growth. But of course, if you include the OCBC Wing Hang loan book, right, the OCBC overall loan book has been boosted by 15% Q on Q, especially for the Greater China part, which is almost doubled. Right, so OCBC Wing Hang currently accounts for 12% of OCBC's the group's total loans. Right, net interest margins were pretty stable. Right, it was down 2 basis point Q on Q. Alright, but that's what we have been expecting since the China money market rates has come down. Right, so I think we can expect this to be the normalized rate going forward. Right, for 3Q14. Right, fees and commission was the main surprise. They grew more than 10% Q on Q. Right, Bank of Singapore continues to produce very strong wealth management fees, when loans-related fees have been growing strongly as well. Right, the only part that we don't like about OCBC all along was the earnings volatility that's introduced from Great Eastern Holdings. So the total non-interest income has been dragged down by Great Eastern's contribution. Right, so over the last quarter, we've seen quite a lot of fluctuations in the treasury yield side. So as a result of that, from the lower mark-to-market that has been recorded over the last quarter, it's impacted the non-par fund income. Right, so because of that, it's dragged down the total non-interest income, which otherwise would have done quite well if you just look at the pure OCBC portion. Another part is also the one-off remeasurement gains, a huge sum of 390 million that's been recorded on the P&L, right, after OCBC increased its stake of Bank of Ningbo to 20%. So after increasing to 20%, it's been accounted for as an associate. So previous to that, it was recorded as an equity investment. So therefore, there's a bit of remeasurement gain. But just remember that this actually has not that much impact on the equity as well as the balance sheet. Right? It's just a recycling of P&L. Right? So the net impact is still the same, right? Just an increase in the stake and accounting measurement. So for OCBC, the share price has been quite depressed over the last few months, and the core banking results has really been doing quite well consistently. So therefore, we have upgraded our rating to accumulate, and target price has been raised to $11. Right, but our stance still remains the same, where we are quite cautious on how much synergistic values can Wing Hang Bank produce together with OCBC. Of course, Wing Hang Bank on a standalone basis is doing pretty well, but going forward, when it's restructured and streamlined to fit OCBC's greater strategy, that's where we are more cautious on. But currently, our rating stands at accumulate. Right. So this is just a chart of video chart showing you some of the key drivers for OCBC. Right. So these are the results that you can find in our report issued last week, where we strip out the Wing Hang Bank results. Right. Of course, with the introduction of Wing Hang Bank, you can see that their balance sheet, where the loans and deposits have been boosted by quite a lot, especially on the deposit front. That's why the loans to deposit ratio actually dropped down a little bit, by providing more liquidity to OCBC's balance sheet. Right. So for their non-performing loans, it's been quite steady at record low of 0.7%. But in insurance, you can see from here, right, it's been quite volatile each quarter. Moving on to UOB, right, UOB for the first half of the year, right, the sentiments were quite bearish as their balance sheet was quite tight. So most people are quite worried on whether they might have to pay for more deposits from fixed D or whatsoever, right? But for 3Q14, they delivered a really solid set of results. Right? Net profit is up 7.2% Q on Q, right? And their net interest margins remains very stable at 1.71%, which is a good sign, meaning that their funding cost hasn't gone up, right? So disproving some concerns that the deposit cost might go out of control. So the fees and comm was the one that really stood out. It grew 15.8% Q on Q, driven largely from investment related, which is actually the wealth management portion as they account for it, and loans related fees. So loans related are usually quite lumpy, but this quarter they did really, really good. Right, main surprise this quarter was their net trading income. So UOB's net trading income is usually quite stable, so they have quite good customer treasury flows. But this quarter they took some positions as well for FX and interest rates, so they made quite a bit of money, about 20 million from there. So total net trading income this quarter is about 220 million. But our view on UOB is still the same. We have always liked them for their resilient earnings profile, strong fee income, capital positions the strongest as well among the three banks, right? And their business approach is usually quite cautious and conservative. So about 2 quarters ago, we downgraded UOB to neutral because their valuation at the point of time, the share price was about close to $25. So we thought it was quite stretched. And truly we said it came down to about $21. So currently, with the strong fundamentals still intact, we upgrade them back to accumulate. So our target price is $25.40. Right. So same thing again, if you look at their net interest income, been on a quite strong upward trajectory for over the last about 8 quarters or so. Right, the non-interest income, which consists of fees and commission, as well as their trading income, has been doing quite well. All right, the loans to deposit ratio is the one that was a pleasant surprise this quarter. They raised quite a lot of solid Sing dollar deposits, so you can see that their loans to deposit actually came down a little bit, so they're in a more comfortable range currently for investors. And they also take part in quite a bit of wholesale funding, where they issue commercial papers and lock in the short-term interest, the low interest rates with short-term notes, right, to provide a funding base, right, without tapping on deposits. So the non-performing loans is quite steady, right, at 1.2%. Right, fees and comm again, providing quite a strong driver for bottom line growth. For DBS, right, it actually came out last Friday morning. Right, so DBS has always been our topic for the banking sector, right, over the last 1 year or so. So for this quarter again, it's a record high quarter, right? Net earnings of about 1B is 8.4% higher Q on Q, and this quarter of earnings was of extremely high quality. There were no one-off items recorded this quarter. So we have broken down into 5 key positives. First up is the steady loans growth, right, 2% Q on Q. Consistently every quarter this year, they've been recording 2% quarter on quarter. And then for the net interest margins, during the first quarter of this year, we actually slightly jumped 6 basis points, right? We were doubtful of them being able to sustain such high margins, right? Because it was largely driven from the higher China money market rates, right? But similarly, for the last 3 quarters, their net interest margin has been holding up, right? So this quarter is highest we've seen in nine consecutive quarters. And the key reason behind this is that they've been able to price up on their loans, especially the trade loans, right, from the trade finance portion, which is a very, very good sign, right? Strong fee income. The net fee and commission income actually grew 10% Q on Q, right? Their wealth management portion is strong, right? Especially after they consolidate SocGen with their books, right? Investment banking fees was the one that was a key surprise, 81% growth Q on Q. So prior to this quarter, we mentioned that they had a strong deal flow pipeline. So you can see from investment banking fees, they actually jumped 81%. This is one key driver that's been pushing the fees and comm forward. But I think we can expect something like this for the next couple of quarters as well, especially for the first quarter of next year. Right, net trading income increased 54% Q on Q, quite similar to what we saw in UOB. Right, so their treasury flows is strong as usual, and for DBS, they also took some positions in FX and interest rates. Right, so this is where they've been getting some quite good gains over the last quarter. Asset quality is robust, still remaining all-time low of 0.9%. In terms of the absolute amount from the Greater China book, we saw a little bit of increase in the non-performing loans or non-performing assets, but this is nothing that's coming out from China. It's actually due to a one-off case in Taiwan, right, which during the end of July, there was the gas explosion in Kaohsiung, so one of their clients was exposed to that. right? So nothing systemic in the Greater China book. So for DBS, their loans deposit ratio, if you use that as a measurement of liquidity, is the most liquid among the Singapore banks, right? And Sing dollar LDR is ample, right? Sing dollar LDR is about 77.6%, and their current account saving account ratio again is the highest among the Singapore banks, being their cost of funding is the cheapest if you compare them. So for DBS, let's go through our main points again. It's our top pick because of their disciplined trade finance business. That's why the trade finance books are growing steadily. We don't see any non-performing loans coming from the China side, right? Their deal flow pipeline is strong, and the banking franchise is very diverse, meaning that even if one portion might not do as well this quarter, it's compensated by another portion of the bank, right? So DBS are our top pick, and we want to reiterate our buy call on them, right? So back to these charts again. If you look at the net interest income, right, very strong growth, right? And the net interest margin has come up over the last few quarters, right? Fees and comm, right, growing quite steadily as well. And then for their loans to deposit ratio, quite healthy, right? And of course, for the non-performing loan side, their loan book is quite healthy as well. It's at all-time low of 0.9% non-performing loans, right? So with that, I'll hand you over to Caroline to talk about OSIM.
Hello, morning. This is Caroline. OSIM has released the results last Tuesday on 28th of October, and for this third quarter of 2014 is a disappointing set of results. The third quarter revenue actually was up, but it's a slowed to 3% year-on-year basis. The net earnings was actually down 28% to 60 million. For the quarter. For the year-to-date 9 months, the top and bottom actually represented 68% and 63% respectively for our full year's forecast, and that's below our expectation. The top line sales growth actually slowed for this quarter, mainly due to the weaker business environment, including the reduced sales of Brookstones after the change of the ownership. In the past, after the change, the sales of the massage chair Brookstone has actually declined from what we understand from the management. And the main reasons for the lower earnings were due to the higher than expected operating expenses from two reason. One is the legal cost of the two disputes at the moment, and another is the startup cost for the supporting infrastructure for the TWG business expansion in Taiwan and Shanghai. For this quarter, they had the company proposed an interim dividend of 1 cent per share. So in our view is that after the results was issued on 28, the price actually dropped 20% to current about 1.82. With the sharp decline of the share price recently, we feel there is an opportunity for investors to revisit the counter. In view of the aggressive TWG expansion and ongoing cases, because for TWG, they will still be doing the expansion in 2 other cities, include the new one is Guangzhou, and then next year it will be open in Beijing. So the infrastructure for the setup cost in these 2 cities will also, we feel that the bottom line will also into the bottom line margin. So the bottom line margin will face a drag in this year and also FY15. The another thing is that the uncertainty regarding the fund deployment from the recent convertible bonds issue may also continue to weigh on the OSIM share price in the near term. However, we feel that the business fundamentals remain intact and the growth driver remain positive long term, with TWG to be a significant earnings contributor once the operating expenses is normalized. We maintain our accumulate rating with lower target price of 2.69. With that, I hand over to Richard to talk about SMRT.
Good morning. This is Richard speaking. Yeah. Last week, on Friday after market closed, SMRT announced their second quarter results. So the revenue was up 6%, and then the operating profit was up almost 67%, and PATMI is up 76%. There's a 1.5 cents interim dividend declared. This is a contrast to last year 1 cent for the same period. The performance was underpinned by the strong comeback in the fare business, where this year for the quarter they registered a 5.5 million operating profit compared to an operating loss of 6.8 million for the same period last year. How this came about was firstly for the MRT business, the profit increased by 6.6 million, and they managed to reduce their losses for the bus business. They reduced it by 6 million. As usual, the non-fare business was stable. Non-fare business includes the taxi, the rental, and the advertising business, and it saw moderate growth at 4.1% year-on-year. That's for the P&L, but then I'm going to talk a bit more on their cash flow statement and their balance sheet. So their cash flow statement, if you look at their cash flow statement, the cash flow is actually quite weak. The operating cash flow is still not able to support their capex, and there was actually a shortfall of still about 80 million. And then moving on to their balance sheet. For the balance sheet that was announced on Friday, which is for 2Q, the total debt was at 740 million. To put it into perspective, compared to their equity book value is 830 million, and their market cap is 2.2 billion. What happened is that they had raised 100 million debt through their MTN program, and they had raised 100 million in the first quarter of this year. For the first half year, which is the balance sheet that was announced on Friday, they only show this 100 million debt, but subsequent to that, they had actually raised another 200 million in October, and that's not reflected in the balance sheet because it falls outside of the reporting period, which ends in September. So actually, for the most up-to-date number, they actually have 300 million debt on their balance sheet now. And if you look at their PowerPoint presentation for the results, so they actually show 68% net gearing on the balance sheet. But if you add the 200, which is already on it now, their net gearing could actually be as high as 92% now. So the biggest catalyst for SMRT now is actually the transition for their North South East West line to the rail financing framework. There was no update given other than saying that the negotiations are ongoing. So the longer that this negotiations drag on, then we have to expect that capex will have to increase again in the following FYs. So the reason why we have reduced our target price despite the good P&L is because of the weak cash flow and the highly leveraged balance sheet. I have to emphasize that the operating cash flows does not support the capex, and then if you look, they are going to pay dividend as well, and the dividend is not coming out from free cash flow from the normal cost of operations. So that's something that you have to be aware of. So that's why we have maintained the reduced rating and lowered the target price to 137. Yeah, I'll hand over now to Colin.
Morning everyone, this is Colin. Just to give a quick update on Raffles Medical Group, which we have initiated coverage last Friday. Mainly, Raffles Medical Group has posted a very strong third quarter results, and this is underpinned by strong growth coming from its hospital services as well as the healthcare services segments. For the growth contributing factors for its hospital service segment, this includes Raffles Medical Group adding new specialists, as well as overall foreign patients, total increase in the total number of foreign patients, and management sees that there's especially growth coming from the Indo-China region. However, the growth is actually offset by a decline in Indonesian medical tourists, which accounts for 20% of its foreign patients. That was mainly due to the weakening Indonesian rupiah against the strong Singapore dollars. So hence the growth in the hospital service segment is lower as compared to the previous year. However, Raffles Medical Group has posted a very strong 16.4% year-on-year growth in its healthcare services segment, and which was mainly due to its expansion of Raffles Medical Clinic network. This also includes the new clinic in Marina Bay Financial Center, which sees very strong growth in the outpatient treatments in this new clinic. Also, other growth contributing factors includes the increased provision of its healthcare insurance services, as well as its acquisition of 2 major corporate client accounts for Raffles Medical. So overall, earnings is up 11.3% year-on-year, and margin remains stable at about 19.2%. This is operating EBIT margin. So the group continue to have a healthy net cash position of about 120 million as of the third quarter. Overall, we continue to see strong growth, mainly due to medical tourism, rising affluence in the region, as well as aging population, both in Singapore as well as in the neighboring regions. Some things to take note are is 2 expansion development projects. First is extension to Raffles Hospital. With this new extension, this will increase the existing gross floor area by 70%, and this will create more room for additional specialist centers, beds, as well as medical research activities. So we do expect this project to be ready in 2017. Another development project to take note of is the New Holland Village Mall, which Raffles Medical Group has actually acquired early this year. So mainly they will redevelop the property site into a 5-story commercial mall with integrated retail as well as its own Raffles clinic. So the project is expected to be ready in 2016. So with this new project, we do expect this to contribute to the revenue growth further. So in addition, Raffles Medical also seeks to expand its business overseas. Mainly, they do intend to plan for 2 new private hospitals, one in Shenzhen and another in Shanghai in China. So they have already signed letter of intent as well as the framework agreement with China Merchants Group and Shanghai Lujiazui Company respectively. However, the plan details still remain sparse at this moment. No concrete detail as of now, right? So overall investment merits for Raffles Medical Group will include, first, the growth prospects in the Singapore healthcare sector, which are mainly due to the rising medical tourism affluence as well as aging dynamics. Second is also there's a potential growth opportunity in China, especially when there are announcement of more concrete plans of Raffles Medical overseas expansion, especially in Shenzhen and Shanghai. Okay. Other investment merits will include the strong cash flow generation as well as its defensive and resilient healthcare business. However, the investment risk of Raffles Medical Group will include increase in capacity and the quality in public healthcare. So this actually will pose some challenge to the private healthcare sector. Right now, as you may know, that the public healthcare facilities are facing a tight bed crunch. So if the public healthcare hospitals can actually resolve this issue, we do expect this will help. This may lead to a reduction in the demand for the private healthcare. Right. Other investment risks will also include rising staff costs, which is mainly due to the tight supply of healthcare professionals, which are mainly consisting of doctors and nurses, and also a possible Ebola outbreak event will have an impact on the medical tourism area. And lastly, 2 of the investment risks will also include execution risks or significant delays in these 2 development projects, as well as regulatory risks in Singapore and China. Right. Overall, we view that the share price is fairly valued, as the share price is currently trading at a forward P of about 30 times, based on our DCF valuation with 7.7% WACC and 3% terminal growth. Right. Positive price catalyst for Raffles Medical will include announcement of concrete plans of expansion in China, as well as a strong boost to Singapore medical tourism numbers. Right. For more details, you may refer to our initiation report, which was issued last Friday. You can also find it, the report that's uploaded on Poems as well. Right. So next, I'll hand over to my colleague, Kenneth, to talk about SODAStream.
Okay, thanks, Colin. All right, just a quick update on SODAStream. 2 weeks ago, SODAStream released a profit warning, talking about the expected weak Q3 and subsequently revised downwards guidance for the rest of the year. So essentially, the third quarter results are out, and it was basically within the lower side of our estimate. Okay, so the update is in Q2, revenues had decreased 125 million versus 144 million Q2. Net income was 9.5 million versus 16.4 million last year in Q2, versus 16.4 million in Q2. Okay, so basically, management expects full year 2014 revenue to decrease 9% year on year, but net earnings to increase 40%, okay, to 42 million. Okay, what's going on here is basically the same story. They're still lagging behind and unable to increase sales in their US business, which is a big market for them. So this is quite a big systemic problem. So essentially, while they do have a base of repeat users in the US, they have difficulty attracting new customers. So hence, soda machine sales have been dropping. Now, ex-US markets, right, they're actually mixed, with Asia growing the most, especially Australia and Japan. Okay, so this quarter, the management released a comprehensive growth plan that encompasses marketing, product, and innovation to address this systemic problem of being unable to attract new customers to the US market. You can check out their website for this plan. It's quite comprehensive. I will not go into details of it because they do touch on many points in the plan, but we do believe that the plan is a good start. Unfortunately, right, we do think that the magnitude of success and time it takes to filter down to the bottom line is likely to actually take more than a year. It's not a quick fix. So because of that, we are suspending coverage until these concrete improvements manifest. However, in the meantime, I just want to talk about some potential upside risks. Okay, so we do believe that next year will be better than this year. Okay, the question is by how much. So it depends on a few things, but some upside risks are they're intending to buy back underperforming distributor markets. Okay, and they also will be having their capacity expansion. So these two things are supposed to increase revenue as well as gross margins respectively. There's also an increase in the speculative nature of SODAStream because SODAStream recently they've entered into a short-term testing agreement with Pepsi. So this is not a rumor. This was actually a filed document from SODAStream to the SEC, where they are basically going to be testing some drinks with Pepsi. Of course, it's still speculative how successful they'll be or whether Pepsi will really produce a range of drinks with them, etc., etc. But in any case, this will probably increase the speculative price volatility going forward. Okay, so to be conservative, we remain at neutral with a target price of $21 due to impaired earnings. So this implies basically 18.5 times PE, which is just slightly less than the canned drink soda market peers, which are trading at about 19 times PE, due to lack of visibility in FY14. Okay, going forward, there's also an update on Heng Heavy Machinery. They released their quarterly results just last Thursday night. essentially their results are disappointing. Revenue dropped 20% first quarter. Gross profit dropped 9%, okay, to 7.2 million. Okay, this is because of so the difference is because actually trading margins have actually increased because of the types of cranes they've been selling. And it's slightly offset by lower rental margins due to the slow ramp-up of project work in Singapore, mainly. However, right, even though there's only a 9% drop in gross margins, reported net profit dropped 60% to 1.4 million. Okay, but however, a big portion of that is because of net mark-to-market FX hedging losses, which will likely be reversed in the future. So if you adjust out the 1 million of that, right, it's still disappointing. The net profit drop adjusted is more on the order of 40% rather than 60%. So why is there a shortfall? This is mainly due to, in addition to the lower gross profit, which was 9%, there's actually been a ramp up of higher admin costs due to staff and higher regional traveling and sales costs. That's the main culprit. The higher admin costs and regional traveling is not going to drop anytime soon because they have been very active in their overseas trading. Okay, so now going forward, right, we do think that quarter 2 is likely to improve because quarter 1 results were impacted by some circumstances like Indonesia's election and Hong Kong boycotts. Indonesia actually has a very big trading market. They have a very big trading market in Indonesia actually. Okay, but nonetheless, even though quarter 2 is likely to improve, we still think the results are disappointing, and we are expected to revise our growth forecast for the year. Okay. Now, although Heng is a play on infrastructure spending in Indonesia, Malaysia, and up-and-coming Myanmar, with the present earnings momentum, it's quite difficult to be excited. The target price, therefore, is under review, and a formal report will be issued after the analyst briefing early this week. Just to give you a perspective on the price at this point, right? At the last time price of 18.8 cents Singapore, just the PE for this quarter alone adjusted is 11 times PE. Okay, just for this quarter alone. So if you assume that earnings do not improve at all, you're looking at 11 times PE for the year. Okay, we do think earnings will likely improve. Now, the adjusted PE 12 trading months is actually 9.4. The present price to book value is 0.83. Now, if you want to be conservative and find the adjusted tangible book value, which we take out basically assets which are non-crane, non-vehicle, and the share of associates, right? You end up with a book value of less than 1. Price to book value is less than 1. Okay. Okay, so that's the update for Heng. Okay, I'll now pass you to Yong Kai, who will update you on the US counters.
Hi, this is Yong Kai here, the US equities analyst. So today I'll just be giving the quarter earnings update for 3 US counters. The first one is Outerwall. So again, Outerwall, there's basically this basic business is kiosk, vending kiosk. Greenbox is a DVD rental. Coinstar is to change coin to cash, and Eco ATM is to recycle electronics. So just to start with this loss-making Redbox Instant JV, they recently terminated it finally because. Okay, why we say it's for the better good is because they finally don't have to contribute any more cash to support this loss-making venture. Okay, and as well as the online streaming marketplace is getting increasingly competitive. If you have followed Netflix, the online streaming, they actually dropped about 20% intraday simply because the US subscribers growth has been slowing down. And also that means that they also don't have to contribute more cash to this JV. For Coinstar, performed well, 28.9% year-over-year increase in operating income. So now this quarter alone is a record $33 million. We expect after-tax free cash flow to be $68 million for the full year, up 10%. Okay, so once again, I want to just bring you back to our calculation, our methodology for the after-tax free cash flow. We take the operating income, we subtract 38% income tax rates effective, and then we'll add back the depreciation amortization expense, which is non-cash. Okay, moving on to Eco ATM. It's a successful. It's actually installed 530 net new kiosks last quarter, so they ended third quarter with about 1,500 kiosks, and they will finish the full year 2014 with roughly 2,000. So based on the economics that we discussed in the report, we expect it to minimally contribute $24 million operating income by end 2016. For Winbox, DVD rentals recorded 10.9% year-over-year revenue decline, which is actually somewhat expected because the box office lineup for the quarter wasn't very strong. That being said, fourth quarter, we expect the revenue to at least match the the fourth quarter revenue to at least match the fourth quarter 2013, which is 1 year ago. Operating income dropped less because of efficient cost management, so we expect after-tax free cash flow to be slightly down 8%. Okay, all in, we apply a 20% holding this company discount based on the sum of the parts. We arrive at $79 target price. This report was actually released last Friday, just 3 days ago. So back then there was a 40% upside, but because the earnings was so strong, the market, the share price actually went up 12%. It spiked up 12% just on Friday itself. So today we're only left with 25% upside, which is still pretty decent. Okay, F&F Ventures Group. Basically, this is a company that was spun off on 30th June. It actually has a portfolio of diverse businesses, ranging from restaurants to automotive supplier. Its intention is to monetize it in the near term. As per SEC filing, strategy will be to achieve superior financial performance, maximize and ultimately monetize the value of its assets. So we're just going to briefly discuss a few of these segments, the performance. Restaurant Group registered 1 to 4% same-store sales growth, even though the overall sector generally shrunk. At the same time, J. Alexander's filed for IPO that could raise up to $75 million. Ceridian HCM drastically underperformed, 6% year-over-year decline as well as lower EBITDA margins. So right now we still lack clarity on it because the quarterly reports, the regulatory filings have still not been filed with the SEC yet. So given the already high leverage, we decided to aggressively slash our valuations. So actually we dropped our valuation for this particular segment down 75% alone. However, this is actually slightly buffered by digital insurance, which registered more than 30% year-over-year growth. So all in, you include a $2.20 per share distribution in the form of Remy International shares, which is publicly traded. You're looking at a potential return of 27.7%. Again, local Singapore investors will have to sell the shares 1 day before the ex-dividend and then buy after in order to save on about roughly $1 of the US withholding tax. Lastly, National Interstate. So this is one of our top special situations play. This is an insurance company that insures basically commercial automobiles such as your passenger buses as well as commercial trucks. None of your automobiles are your passenger cars. So second quarter was disappointing, but third quarter is picking up. Operating income up 10%, rates on policy renewals up 9%, which is a trend that we have seen since 2012. And despite deliberately non-renewing $30 million worth of unprofitable policies, the gross premiums returned are still up 8% to 490 million. So it's on track to achieve the 2014 stated revenue target, but the net income target will be missed. Then again, we have never, if you read all our reports, we have never talked about the 2014 forward net income targets because our emphasis is always on the 2015 with the contribution of Van Niner. So to try and be more prudent here, we apply a 10% haircut to the more conservative projections of 2015 and 2016 net income. And this works out to $53.8 million. So the breakdown is as follows. Core net income will be $43.4 million and balance from Van Niner. What investors want to know is that since it's actually disappointed for 2014, is this $43.4 million core net income actually achievable? We think it is because if you look at our breakdown, from the investment income itself, that is actually pretty passive. You're already earning about $36 million. So fast forward 1 year, we think you can earn roughly $39 million. And if you have just a slight underwriting profit of 2.5% margin, you'll be looking at $18.8 million underwriting income. You add both of them together, you sum them up, and then you apply a 25% effective tax rate, you'll be looking at $43.4 million core net income, which is what we arrived at. Target price revised downwards to $38 because the special dividend obviously it doesn't look likely given that there's only 1 quarter left and 2014 the results are not that fantastic. That being said, again, you recall the failed privatization offer in 2014 at $30 per share, which itself is higher than today's share price. This $30 per share, the privatization failed precisely because the offer is unfair and there's a lot of dynamics at work that resulted in lawsuits. At our $38 per share target price, we are still looking at roughly more than 30% upside from today. And also, at the same time, we'll be collecting around 48 cents per share of annual dividends from this company. So, just to sum up, Singapore, we have OCBC, UOB are both accumulates, DBS buy, OSIM accumulate, SMRT reduce, and Raffles Medical new initiation is a neutral. For US, we have Outerwall, F&F Ventures, and National Interstate. All three of them are trading buy. Okay, with that, we open the floor to questions. Thanks.
Earlier question on trading income of UOB. Can give a bit of a brief background. So usually there are a few categories of income for the banks, so it's quite similar. So start with your net interest income. Next one will be your fees and commission. The last one will be your non-interest income. So under the non-interest income, there's a portion called the trading income, right, as well as recognition of AFS securities when they recycle the P&L. So the trading income side is usually booked from the trading desk, right? So this comes from two sources usually. One, of course, the usual proprietary positions that's taken on by your trading desk within the bank. And then second, usually the main bulk of it is from the customer treasury flows, right? So usually when the customers are involved in other stuff like taking certain loans, certain form of financing, or conduct some form of business with the banks, they usually have some form of risk management, right, to hedge off usually the main bulk of FX risk and interest rate risk. Right, so in these kind of hedging activities, the income is usually booked under the trading income portion, right? Not only for UOB, but also for their two banks as well. So that is what the trading income is.
Hello, there's a question that says, will the legal case affect OSIM share greatly? Okay, from what I see, for the two legal cases, one is actually the trademark for the Hong Kong with one of the tea company. Also, the other is a shareholder dispute. From what I see, because these two, what I see is that these two cases is not okay. How should I put it? The legal case, from what I see, is that it will not affect the OSIM business greatly in this sense. Share-wise, maybe at a point in time, if the verdict is in against OSIM, maybe there will be a short-term decline or so. But in long-term wise, because these two cases are not due to like there's a product issue or anything that I do not foresee that it will affect the OSIM business long term. As for right now, Amara, there's another question on Amara. At the moment, we do not have further updates on Amara, pending for the results on 12th of November. With when the results are out, we'll give the further updates on Amara. Thanks.
Hi, this is Richard speaking. There's a question on about the 200 million debt for SMRT. Where was this announced? Yeah, this was announced on the SGX website. You can go to the SGX website, then there's the company announcements, and then you look for it at SMRT, and you can find it. The date that it was disclosed is, I think, 16th of October. Yep, 16th October. So you go there, you will see it.
Okay, we have a question here on what's the difference between our trading buy and buy. Actually, in terms of conviction, there's no difference of conviction. Okay, but trading buys are usually because in the interest of time, sometimes we want to shoot off an initiation quicker, so we do a trading buy, so there may not be a full model backing it with a full earnings forecast. The other thing is also trading buys. We also put for companies whereby the story may not be so ongoing, right? But there's a strong chance for a earnings re-rate or a valuation re-rate. Okay, so for those companies, we sometimes put a trading buy. So in that sense, we may not have continuous coverage on it, although we feel that there are some strong fundamental factors which will drive a very big move in the counter. Okay, so those are the main differences. Okay, we have some general questions on the market. Basically, people, one of the questions is it a good time to buy now? Okay, I think in terms of fundamentally wise, we believe that we're still in the bull market, and we have held this conviction for a very long time. Okay, what we've had is a shallow correction, right? And unfortunately, the correction was not deep enough to actually say that there may not be another one later on. Okay, so basically what we're saying is that I think in terms of strategy, for those who are looking at holding things for the long term, I think it's pretty safe to do so, because we do believe we're in a bull market. If you have a trading outlook, right, and if you want to buy in now, okay, you should still keep your stops tight, because we don't believe that this correction was deep enough to say that we're going to be on a very long uptrend now. There still could be another leg down from that perspective, because the rebound is now a little bit overbought. Okay, so that means we still could have another leg down, although it doesn't seem like the case at the moment. It never seems like the case when there's extremely strong buying. Okay, but we can confidently say that in terms of underlying macroeconomic factors, we're definitely still in a bull market. We're pretty sure of that.
Hi, Kenneth here. Just to add on to what Josh said, right? Yeah, so we do agree that fundamentally we're still in a bull market. Now, when we look at the US market for the S&P and Dow Jones, right? They've actually had a strong rebound, and the rebound was actually accompanied by actually good breadth as well. So what this tells me is that the fundamental picture of the bull run still going on is actually still intact. But that being said, right, how do you trade the STI or even the S&P? What you do is you assume that it is an uptrend, but at the same time you look at the short-term cycles. And so if you would you can look into simple things like RSI or other forms of overbought, oversold conditions, and you can lightly time your entries based on that. So the thing is that right now, if you look at things like the RSI, right, we're not that overbought yet, but we're overbought soon. So you might want to, based on your time frame of investment, right, that's how you would tweak how and when you would buy or not.
Hi, we have a question on Sino-Grainers. One of the audience asked why is our take on it. Okay, just to be upfront about it, our house currently don't have active coverage on this stock. Okay, from what we read from news, right, I just want to highlight that the deal with the Thai the placement deal with the Thai conglomerates is not a done deal. Okay, so they've actually revised it just about on 29th October, if I'm not wrong. What happens is that based on the new terms, the refined terms, if the share price drops below 40 cents, either the Thai conglomerate or the company has the option to terminate the deal single-sidedly. So that means that if the actually a lot of this whether the deal goes through or not does depend on the share price. It was 39.5 cents when the announcement was made. Today is 45 cents. And if it does go below 40 cents, we think that there could be a high chance that the deal is terminated. And maybe investors, I mean, we don't know how they react to it. All right. Thank you.
Hi, we have two questions on Keppel and also Sembcorp as well, so I'll probably address them together. Right, so there's a question on whether oil price correction is coming to an end and what's our thoughts on Keppel and Sembcorp. Right, for the oil price, for the oil and gas sector, it's largely dependent on the oil price, currently still hovering about $80. So I think for that, we still have to wait to have a more confirmation on which direction is the oil price moving currently. So probably we're into 2015 to see. But on the whole itself, the low oil price is creating quite a bit of a bearish sentiment on the entire oil and gas sector. So for us, we still stick to our call to avoid the especially rig builders and anything on the upstream sector. Right, so for Keppel, our call is still on neutral, and for Sembcorp is on reduce. Right, but that being said, right, the pressure a lot of it is more on the deep water side as well. So we haven't been seeing any order wins coming in for any deep water type of rigs. Right, whereas for the shallow water side, that time about 3 weeks ago, we had a webinar on the offshore and marine sector, which we said that for the shallow water portion, the high specification jackups we will still expect to see order wins coming in. And true to be said, last Friday itself, Keppel itself has received an order from Japan Drilling for a 240 mil Super B class jackup. Right, and then the same company itself has ordered a rig from Sembcorp today, just been announced this morning as well. So it's a 240 mil jackup as well as Pacific B class 400, if I'm not wrong. Right, so for the shallow water portion, we're still seeing, I think we'll still see order wins come in, especially for the high spec ones which are built by our Singapore yards. But for the deep water side, right, that's where a lot of pressure is coming in because of the lower oil price. Right. So conclusions for now is just to remain more on a neutral stance on the rig builder side, right? Because the order win momentum might not be as strong going forward for the next 1 year or so.
Hi, there's a question on why has SMRT such poor fundamental jump in stock price? Yeah, so you see that the income statement looks good, but then the balance sheet and the cash flow statement isn't that good, and so I think that people are focusing on just the top line and bottom line, the revenue and the net income, but then you have to look at the whole statement in totality. And I mean, if you read the report, we say that accounting profit is not the same as cash flow. So if you go and look at the SMRT, their financial statements, you look carefully. For the first half year, their cash flow from operations, even though it's profitable, they are not generating enough cash flow to support their capex. So the jump in price is probably because people are just concentrating on the income statement, but not looking at the other two statements. And moving on, there's another question about transport stocks and the oil prices. Yeah, so we have ComfortDelGro and SMRT, which is under our coverage. They're both transport stocks, and for their operating cost component, actually fuel cost is their second biggest cost component, which is electricity for the trains and diesel for the buses. They do not incur diesel costs for the taxis because that's paid by the taxi hirers. So if you look at the income statement for SMRT from last Friday, actually their fuel costs didn't increase a lot, and they have benefited from this reduction, lowered fuel costs. So probably ComfortDelGro will see that again, and they are going to announce their third quarter results next week on 13th November, so you can take a look at what's going to happen, what they're going to announce then as well. Thanks.
I have a question of Kim Heng. Will the crude oil price affect the results of Kim Heng Offshore? Unlikely to be so. Alright. Anyway, for as long as oil prices, no matter what oil prices are moving at, right, the dependency is more on the ages of the rigs that are out there in the market and whether they need more servicing. But of course, on the general whole itself, right, if the oil prices are really, really low, alright, then it might not be as feasible to use the older type of rigs to drill for enhanced oil recoveries or perhaps even to engage and reactivate all these kind of old rigs, right? But as we are talking about probably oil price of $70 and below, then probably we might see that happening. But at this current level, unlikely to be so.
Hi, there's a question on relating to SingPost, whether it's at the high end. Currently, we do think that the share price of SingPost, since our initiation about several weeks back, it has really rose to about 10%, and it's inching very close to our target price. At this point, we think it's closely fairly valued at the current moment. However, we believe that there's still room for potential re-rating of the target price upwards, as SingPost is still in. There's a plan for a joint venture with Alibaba Investments, and the details of that joint venture is still remains sparse at the current moment. So we do believe that any announcement of any concrete plans of this joint venture on how Alibaba and SingPost are able to tap on the e-commerce opportunities will be a big positive price catalyst for SingPost. So right now we think that it's pretty it's not cheap at the current moment, right? Question on the distribution phase. I'm not too sure on what is your exact question on this, right? So appreciate if you can rephrase it. Thanks.
Hi. There is a question asking, is OSIM loss of sale to Broadstones permanent or just for this quarter? Per the management saying is that this quarter there's reduced sales and they expect it to pick up next quarter. But for my point is I rather play on a conservative side, because in the past Broadstone is still under OSIM, so they could actually sell more shares to them. But right now, since there's a change of management, I rather take it that this loss of sale to Broadstone is the reduced sales to Broadstone is rather more permanent, to play on a more conservative side, since there's a change of management and it's out of OSIM control now already. Thanks. Hello, that's all we have for today. Thanks for tuning in. I hope to see you guys next week. Thanks. Bye.